A few weeks ago was just your average trading day, and I was reviewing my spreadsheet, looking at what stocks I was going to purchase an additional $150 into. I went onto Yahoo Finance, the app, to look at what the real-time pricing was, and that's where I saw it. A Simply Wall Street article warning me about the stock I was about to purchase because of a high payout ratio. So that's why in this video, I want to talk about payout ratios and let you know what I ultimately did. Hey everybody, my name is Steve Coleman. I hope you and your investments are doing well. Welcome to my channel where I put $150 every week into my Wealth Simple Trade tax-free savings account to grow some passive income. By the end of this year, I hope to have $10,000 saved up. Over 5 years, over $50,000. Have any of you been in this situation where you have planned your purchases the day before and you go to pull the trigger and all of a sudden, boom, there's some article, there's some news, there's some kind of headline that catches your eye that basically is warning you against buying the stock that you're about to do? This is the situation I was in. And I know better. They write these headlines as clickbait to get you to read them. And, well, I kind of got sucked into it. So I read the article. I was really curious what they had to say. It was as if it was actually written for me. The company in question is Diversified Royalty Corp, ticker symbol DIV.TO, on the Toronto Stock Exchange. And this was 2 days before their ex-dividend date, which I wanted to buy some stocks. That way I would be able to get the dividend payments in the following month since they pay out monthly. And the headline, don't buy Diversified Royalty Corp for its next dividend without doing these checks. Again, I couldn't not read the article because I was doing that exact thing. I was buying that stock before the ex-dividend date to get the dividends. So I was really curious what the article had to say. So let's dive into that a bit. The article's main point was, if a company pays out more in dividends than it earned, then the dividends might become unsustainable. Hardly an ideal situation. An unusually high payout ratio of 261% of its profits suggests something is happening other than the usual distribution of profits to shareholders. As somebody who's primarily investing in stocks for their dividends, it makes me realize that this is something that I probably should be paying a little bit closer attention to, which is why you've heard me say in other videos, and I'll say it again, it is so important that we do our research into the companies that we're investing in. Don't just buy them on face value because the price is right. Look behind the figures. I know it takes a little bit of extra time, but it's important that we do it. But more important, it's really important that we like and subscribe to this video so that way I can help do my small part to kind of help keep you informed and I hope entertained. So if you haven't looked into this particular stat before, let's talk about what exactly the payout ratio is and how it might be different across different industries. According to Investopedia, the dividend payout ratio is the ratio of the total amount of dividends paid out to the shareholders relative to the net income of the company. It is the percentage of earnings paid to shareholders via dividends. Any money that the company is not paying out in dividends, it is reinvesting in itself, which is why that payout ratio I find is really important for any companies that are really in that growth stage. You want that company investing into the company itself versus making the shareholders happier. So that way they can grow the business, which actually grows the stock price, which in the long term can actually pay out more to the individual investor. But it isn't always that simple. It will differ across different industries as well. So let's take a look at 3 different industries. If we take a look at 3 of the top telecommunication companies on the Toronto Stock Exchange, we'll see that 2 out of 3 of them have a payout ratio higher than 110%. And these companies are successful companies. They have a history of paying out dividends, and some of them are even listed as dividend aristocrats. In the financial sectors, we'll see a more traditional payout ratio spread where anything less than 50% is considered really good. And finally, we take a look at some of these more consumer type companies. So here I chose Pizza, Diversified Royalty Corp, as well as A&W. So these are companies who own a trademark to a certain business, and then they have a franchise model. As you can see on this graph, Diversified Royalty Corp is clearly, at the time of when I grabbed this data, very, very high compared to the other two. The other two are higher, and that might just be the nature of the business. When you see a high payout ratio, it often means that a company might be trying to mask a very, very bad financial situation that is happening to them. And if you remember the last year, all companies had kind of experienced a really, really bad financial experience with COVID-19 hitting in 2020. Businesses, basically everything be kind of locked down. Things are slowly beginning to pick up again, but clearly not at the speed that is going to help Diversified Royalty Corp lower that payout ratio. Now, they have just increased their dividends to shareholders as of August after reducing it back in April 2020. So is that them trying to attract more investors? Or should we really be patient and wait for their third quarter report to come out in November 2021 to really get a clear glimpse of what is going on in their balance sheet? Are they profitable? Are they not? Is this a company that has growth or don't they? So the payout ratio is great as an indicator to kind of see what is happening with this company, but you almost need to do more digging and more understanding of the different industries to kind of really clearly understand what that payout ratio means for that industry, as well as what it means individually for that company in context to what is really happening in the world right now. In the end, I decided to go ahead and purchase some Diversified Royalty Corp stock, ticker symbol DIV.TO. Despite this high payout ratio warning that I received through this article, but I probably will not be putting another lump sum of $150 into Diversified Royalty Corp for a while. I'm going to wait till I can see what the outcome of this their third quarter results are. Plus, there is a whole list of other companies that I could be putting $150 towards. So it's not like I'm going to have any problem spending that money. So I'm glad I did read the article, because it reminded me that it's always important for myself and you to always do our homework, to always be up to date on what are the different financial terms that we should be aware of, as well as like just not the day-to-day, but just maybe the quarter-to-quarter operations of the businesses that we're investing in. More importantly, I'm reminded that it's important to go into investing with a plan and have some simple rules that you can follow to guide you along your journey, which is why I made this video here, which talks about the 3 simple rules that I follow, and I've been doing this from the beginning, and so far everything's working out for me. The other video that you can sink your teeth into is this pizza analysis video I did back in June. Let me know if you'd like me to do an update on that video to kind of compare what I saw back then to what is happening with pizza now. I think it'd be interesting to kind of do that every 3 months or every 6 months. So let me know in the comments what you think. Again, please like, subscribe, hit the bell, so you'll be notified anytime I post a video. But then guys, keep it in the green. I hope you are staying safe and doing well, and we'll see you in the next video. Take care.